Now we're going to turn to the refined product space and look at them, piece by piece to understand, what are some of the drivers of each one and where do we expect them to go in general. So when we look at, what comes next, we just wanted to just touch on, the chart that we always like to look at and it's looking at finished motor gasoline, kerosene, jet fuel, kerosene, jet, distillate, and residual fuel. Sorry for shortening things, but these are the key kind of economic drivers, the key drivers for mobility. And this is what we've been saying, where we're going to continue to see some of this grind up, but again, then see this flatline and flatline around this 15 million barrels a day of demand on that 5-year average as you get different drivers, because at one week it'll be gasoline, another week it will be distillate, another week it'll be a mixture of maybe distillate and jet fuel. And when you look at this week, gasoline kind of went sideways and you saw a big driver of distillate and jet. And that's something where we think, again, it'll come back down. Not that it's going to get reduced in a huge number, but it's just, as we keep describing it, as that chevron pattern of just, up and then down the next week, because you do get that lumpiness. We do have those issues within the supply chain in terms of getting gasoline from the blender to the pump, getting diesel from the blender to the pump. Because remember, they're using very similar, or if not the same supply chain, depending on the location that you're in. So there's a lot of mobility issues that, again, also drive some of the lumpiness in those demand numbers, because it's implied demand. It's implied of what's leaving from one storage center that is then being deployed into the rest of the market. So typically you have that storage going from one to the other. So these are some of the shifts that we continue to see. And we always like to look at it on a streamlined level as well as the week over week. And typically when you look at, like if you go back to 2019, we normally have that trend up to about 16 million barrels a day. And we just expect to be about 1 million barrels a day off of normal when you put all of these and aggregate them together. So currently we're at 15.5 versus last week of 15.17, and we're sitting at an average of about 15.1 right now. So when you look at what some of the shifts are, we want to look at what has happened in general. So when we look at refinery throughput, it's just below, remember that 91.1% is just below 16 million barrels a day. So it's right at about, let's call it 15.9. And then when you look at this chart and you kind of see where things are, and then you factor in imports of refined products, you get an idea of why you're getting to this level and why we're seeing some of these draws out of product, because this is still summer demand. Summer is peak demand. So it makes sense to see, when you have refinery throughput at that level, to see some of the draws of product. But even with that level, we're still not getting the draws that we would hope for. And again, comes back to what we've been saying from March, April, and May. It's coming from the import market. And that's the one that we're going to look at again as we go through this. But then when we talk about from Descartes had the gasoline usage for this week at 9.6 million barrels a day. When we look at Gas Buddy, they were about 9.55, 9.57. So we're right around that level, which again is just going to lead to some of that support in gasoline demand. But it's just going to, because of the lumpiness of moving it from point A to point B, that's where we're going to see some of that sideways move in general. So then when we go a little bit deeper into distillate, you can see that there was a draw of 3 million barrels across the complex, and it was really across the board, with the biggest draw coming from Pad 3 of 1.74. Now, we did have an increase in imports by 100,000 barrels a day, which is still kind of against norm. Like you can see that's 65,000 above a year ago. And we typically get some spot cargoes, but nothing really major. And when we look at, okay, well, what was production? Well, let's look at what production was for distillate. So then when we look at the production side of disti, and I just can't, yeah, here it is. So when I look at distillate, it was down about 78 basis points to down about 164,000 barrels a day, going from like 30.6, 30.5 to about 30% of yield, where we actually got a big increase in gasoline yield. And when you look at some of the shifts, so think about it like this, just to try to explain it briefly. When you can adjust the cracker and based on what catalyst are you using? What type of crude are you using? And what type of heat are you using? And how long within each part of that cracker can adjust what you're going to yield. And it's within percentage points. We're not like, you're never going to say I can do this and run 100% gasoline. That's not how this works. There's always going to be a split. So it's just, how do you maximize one versus the other? And you can see here that there was a big shift away from distillate and towards gasoline, which is going to be something to watch. But when you look at the shortage of naphtha, and shipments into Europe are at 9-month highs for naphtha, and that's being recognized as gasoline from us, just because when you look at it's really a naphtha blend that's going into Europe, which has been supportive of our gasoline exports when you look at how they're being factored. So again, this is something that will remain a fairly flattish, but the trend remains up. You can see, and when you smooth it out on the 29-year average, you can see that the trend is up. We're still moving in that direction. It's just that the pace of those builds has slowed down, and it's going to be an adjustment. Exports are now well below seasonal norms over the last 5 years. That's going to remain under pressure as we have actually a decent amount of new product entering the Atlantic Basin, because a lot of this distillate normally ends up in Europe, and we're just not seeing them buy on the same level. So then when we look at demand, here you can see the implied demand. We're not at the peak that we've had, about 3 points higher, but again, you can see that the lumpiness, we were at this weird low, which we said was too low. There was a lot of seasonality that was tied to that. As you can see, it was on July 4th. Then you get that recovery. Now we're back to the top. The next one is going to be something closer to the 5-year average, but still above the 5-year average. Because as we've been saying since last year, diesel demand is the bullish side. There is a lot of diesel demand given the trucking side, the rail side. So this is going to remain elevated across the board. And here's where we were starting to get some of that support. We got a little bit of a bounce off the low, and we think that we're going to stay within this, let's call it 150 to 175 level, as you start to see some of that climb back up. But there is more rail that's being relied upon, just because there's a lot of opportunity. You can deliver larger shipments to it, just because you're going to have more product to move. You're going to have more opportunity to move things in a bigger size. So when we look at what the rail is this week versus last, so we're still up, when you look at intermodal, there's a little bit of a recovery factor, just because you had that slowdown from UNP coming from West Coast into Chicago. So we're going to start to get some of that coming back. When we look at some of the shifts in general, the intermodal side still remains at an elevated level. That's going to stay strong as we go through the end of the year. But when we look at motor vehicle and parts, that was down big year over year at about down 29%. That's the one that's going to be a little lumpy, and we're starting to see that's more of a supply chain issue. So again, that's going to ebb and flow. We could, especially when you look at metals, metallic ores, that's elevated. But when you look at forest products, farm products, grain, that's going to continue to be strong. And then we expect to see petroleum and petroleum products, stay fairly elevated. But again, total intermodal units is the one that we see the most bullish side in terms of these movements off the coast into the market, and then back to the coast to bring some either backhaul or just empty containers that can go abroad once again. So then when we turn to some of the issues that we talked about last week, here you can see that there was actually a big drop in July 25th to 31st, just based on TEU volume. And that's coming back to the issues with UNP cutting some of the pickups, wanting to clear out Chicago a bit more. You saw some of the disruptions because of that. A lot of that has then been kicked into next week, which you can see the import volumes still remain elevated and continue to be elevated over that time period. When you compare it to previous years, it remains high. And we'll talk about that more in more detail in segment 1 of the Econ Show. On the heat side, we're starting to get some break in the heat. We're actually getting some cooler weather across the Northeast and across parts of the South. And then you can see in some other areas, it's a little elevated, but again, nothing crazy past normal. So those in Texas, what I forget what it was called, the Superdome has now broken up, which is a positive. Obviously, the heat will abate a bit, and you'll start to see some of this. But it's not that you're going to use natural gas anymore. It provides a little bit more opportunity, because when it's really hot, you tend to stay indoors. This will pull people out into more of those parks. So now when we look at gasoline stocks, you can see that there was a draw of 2,225,000. It takes us below the 5-year average by 1.5 million. But when you look at the draw itself, the draw was completely driven by Pad 1. Pad 1 had a draw of 3.18 million barrels. Now that's right in line with the 5-year average. It's only 500,000 barrels below. But everything else had a build. And that's I think, the crux of what we're seeing right now that we just wanted to pause and talk about for a minute, is the bifurcation in this market. So then when we look at gasoline imports into Pad 1 were down 419,000 barrels a day. But when you look at some of the other areas, and Pad 5 was down 90,000, but up 69,000 barrels a day versus the 5-year. Pad 1 was up 50,000 barrels above the 5-year. So even though we had a move from last week's total of about 1.37 million barrels a day of gasoline imports, it's only down to 909,000 barrels a day. And that's still 67,000 above that 5-year average. We still think this is going to trend lower. There's still cargoes coming in, especially into Pad 5. Pad 1 still has more, but not at the same rate and not at the same level. So as we were saying last week, we were expecting something closer to the 750 level. Instead, we got this big spike up. So now we're starting to see some of this normalcy, and we're going to move closer to that 850, 800 level, depending on, if we get some of those delays. So just to put this into context, so when we look going forward, transatlantic gasoline arrivals in the U.S. slipped to 377,000 barrels a day, which is the lowest since the end of June, at June 24th, which was compared to 480,000 the previous week. 2 tankers discharged a total of 566,000 barrels of gasoline in California, and 8 tankers discharged about 2.1 million on the East Coast. So then when you look at the July loading of shipments, so when we look at Asia to America, they fell from 280 last week to 210,000 tons. And the difference is just these 2 cargoes. So right now there hasn't been anything new that has been booked, but we expect to see some adjustments to that. Now, when you look at the storage level, you can see we're still above where we were at the low point of 2021, and we continue to just go sideways. And if you look at how this normally shifts, we typically get draws this time of year. So we're going to continue to see some of these draws, especially just based on timing and the fact that refiners are operating at such a low level. But because we are seeing this shift where you saw the production increase by 2.24%, essentially maxing out gasoline production at the refining level, trying to create as much gasoline without operating at a 93 to, or seasonally speaking, 97% utilization rate. That's what's keeping this elevated, as imports are coming closer to seasonal norm, but we still are below seasonal demand, which again speaks to kind of why we're seeing some of the stickiness in storage. And as we go through the remainder of the year, and if we don't really start to see these builds pick up, which are unlikely, we'll see builds, but the pace is going to be slow. That's going to bring us into a more bearish situation as the whole cloud normally comes down. As you can see, flattening out in September, then starting with builds. So the comps are just going to get easier. Now, on the positive side, when we look at some of the underlying pieces of what's to come, this is U.S. consumers' intentions to spend mildly improved. So this is looking at spending. Now, what are people searching for? So when you look at the blue, which is starting to see a little bit of an uptick, that's hotels, that's apartments, flying, restaurants, movie theaters. You're starting to see that pick back up a bit after dropping off very hard from the peak of March 28th. Because remember, our whole thing was you were going to get this surge in March. Everyone was getting excited. They're getting their vaccines. If they have money, they're going to go travel. But that was a subset. Now, as we come through this essentially the peak of summer driving, summer vacation, you're starting to get a little bit a creep back up of activity, but you're not coming to the peak. And when you look back through time, so look at July 4th. So when we look at July, comparing apples to apples of 2020 versus 2021, you can see that there's normally a pickup in activity from July 1st till about August 15th. And now look at what we're seeing here. We're seeing a similar bump, but just at a reduced level from 2020. So again, this is going to provide some support for activity, but just not get as much into the market. Now, when we look at the Gas Buddy data on the weekly demand, you can see that we actually crest right above the July 4th number, which is a positive when we look at some of the data sets. So weekly, Sunday to Saturday, U.S. gasoline demand set a new 2021 record, rising 2.3% from the prior week and was up 3.1% versus the 4-week average. Weekly demand was 0.6% higher than the week ahead of July 4th. So again, that was a nice little bump, but as we've been, our view is that you'll get a 1% move up, kind of a smaller move down. This is one where we think we're going to come closer to where we were last week when you look at some of the adjustments over that time period. And you might be saying, well, why are you saying that? Right now, you've seen a kind of that, let's just call it a step ladder up. And it's because when we look at some of the activity, so Gas Buddy did a survey, how gas prices are impacting Americans' decisions to travel. And here you can see from May to July how that has changed. So when you look at May, with gas prices too high, 46% said yes. Now in July, 50% have said yes. And then if they were asked, are they irrelevant? 53 said yes in May, 48% said yes in July. So that's where you're starting to get some of that bleed out, but now going a little bit deeper. So digging in a bit more, some of the quotes from the article itself, which I retweeted if you want to find the article. So while the recent spike in demand shows that Americans are still determined to get out this summer, wavering confidence in road trips says people might be worried about budgeting for high gas prices and seeking adventures closer to home, which is what we've been talking about. More locality, more parks, more, do I want to drive 4.5 hours or 2 hours? And it's what we're starting to see some of those shifts. In early May, 57% of Americans were planning to take a road trip, according to Gas Buddy's 2021 summer travel survey. Since then, gas prices have risen to a 7-year high. A new variant of COVID has spread throughout the country, and a pipeline shutdown bringing gasoline shortage to the southeast. Today, only 46% have or still plan to hit the road. Gas prices have been steadily climbing since early November to prices we haven't seen since 2014, with a national average of $3.14. 50% of Americans now say high gas prices are deterring them from taking a road trip, up from 46% in May. Now, if you factor that in with the other data that we've seen in terms of Google search, that's where you're still getting people going out, but the searches have increased. People are Googling it a bit more, but they're looking to be a bit closer to home. And then when we look at the Google data in a minute, that's what we continue to see. There's, recreation's moving up a bit, but that at-home residency is still elevated. That parks is still high. And that's where we continue to see people staying a bit more local versus moving out. So then when we look at gasoline prices, they had a bigger drop of about almost 2 cents. They went from $3.153 to $3.136. So just going out to the pips. So when you look at then diesel essentially didn't move. Went from 3.344 to 3.342. So again, you're still very high on the diesel side, which is more impactful when you're thinking about supply chains, when you're thinking about cost going through. And then in the Econ show, we're going to talk about the shortages on inventories, which continue to grow, moving out further and further into the worst ever, if you want to talk about supply chain situations. While gasoline has moderated, you're still above that 310 number, because we were saying that previous years, it was always talked about 350 gets people to curb. But we were saying that it's much closer to 310, 315 that people start to adjust their patterns. And that's something that we've been saying. That was some of the calculations we've been doing. And now when you look at Gas Buddy data, when you look at their survey, when you look at Google search information, that's starting to play out more and more, where we're just not seeing people as active even as they were last year, just given based on some of those costs and some of the increases in flow. Now, when we look at blending components, here you can see that blending components still are at the second highest they've ever been in terms of flow. It had a draw of 1.86 million barrels, but it's still 4.1 million above the 5-year average. So when you look at just what is the blending side to move it to the end user, this is where we're continuing to see some of those delays. We're still elevated, and as we've been saying, the draws have been very slow. If it realistically, even last week when there was a draw of 120,000 barrels in gasoline, there was actually a build of almost 2 million barrels of blending components. And this is going to be, I think, the more problematic. So when you look at what refiners have done, right? So what have they done? You're seeing some of those imports come down, some of the increase in production of gasoline, which means that there's going to be a higher demand of blending components. So we should start to see some of this accelerate down and come down to about where we were in 2019. But the problem is you can see that there's normally a drawdown. So as we're not getting the same type or the same pace of drawdowns, that's going to put us into a tough spot as we get into September, which is why we're starting to see some of these adjustments on refinery utilization rates. Now, when we look at total gasoline demand over the last 15 years, you can see that we're just below the 15-year average, which is tough when you consider where we were, because this is going back to 2006. And if you just look at the DOT or the Department of Transportation data, every year from 2006 to 2019, it's been a steady move up every single year. So that just means that you're also going to have more gasoline demand. And now you're starting to see that, again, fall below the 15-year average. Now, when we look at the last 5 years, here you can see we're just going sideways. And as we were saying, that we expected to get one pop up, because if you look at 2019, you can see kind of that lumpiness, which is that yellow line where you spiked into July 4th, you had a big drop down, and then you had a spike after July 4th, after, again, you have to repair, refill. And it doesn't really come to the same level as July 4th, but again, you see some of that movement. Instead, we just went sideways. And it just means that the refill is going to be a bit more measured, and you're not going to see those extremes again. Instead, we do expect to see at least one more pop up, but it's not going to be on the same level as it was historically. And as we said last week, we think it settles out at about that 9.3 million barrel a day average. Now, that doesn't mean it can't go to 9.4, then down to 9.1, up to 9.2. It's just when we look back over the summer, that's what we're going to say is that we've been sitting right here, again, below the seasonal norm. And this is where you're seeing it play out. Parks still remain elevated. And this is where it's key to just remember in your mind's eye that Google chart, when you look at what happened last year, you had parks accelerating, you have parks at the same level, you have residential still elevated versus where we were in the summer. You have, but you do have retail and recreation a little bit better. So that's where you're getting, because we are consuming more gasoline than we did last year. And that's part of the reason you're starting to see a little bit more there. Workplace is still fairly flat, but better, or I should say higher than it was last year. That's accounting for more consumption. But you are seeing more and more people take transit, and you're starting to see more people on the transit line. It's still nowhere near where it was, but getting better as more people get vaccinated. The question is then going to be, as some of these case counts increase, not to say that they have to, but if they increase, are you going to see offices say, look, 4 weeks home or 2 weeks home? I don't think so. I think we're going to see them power through it. And just because a lot of these companies have testing protocols, they have vaccination, a large percentage of those individuals are vaccinated. If they're not vaccinated, they've likely had COVID and they have the antibodies regardless. So those are things where I don't think so, but that's just going to be something to watch because that could push workplaces back down to where we were last year. But again, not something I think is likely. Apple Mobility, when you look at, and again, this is based on search, not travel, just those little nuances. Italy is right back to where we were last year in July. The U.S. has a bigger upside, but really kind of coming back into the same as we were last year, a little bit better on the higher end, which is something to be expected and something that we talked about in March and April when you did see some of these movements on just vaccinations, things getting better, because our view was you're going to get an increase along seasonal norms just at a stepped down level. So you were going to get an increase along seasonal averages just below where we should, quote unquote, should be from 2019, 2018, using that as a bellwether, with the UK and Germany following in lockstep to where they were in 2020. So now when we look at propane, propane had a build of 1.86 million, still 10.7 million off the 5-year average, right at the low end when you look at 2017, 2018, just as we've been saying since essentially the pivot in March. We expect it to track 2017 and 2018 almost perfectly, because we will get a little bit more, again, wet gas production. You're going to see some of that NGL demand, and it's just pricing. I mean, I'll just look at pricing real quick. We're still at $1.09. So when you think about just the amount of demand to keep us at almost over $1 in terms of price, exports continue to be very robust. Now, speaking back to some of that vaccination side, here you can see the vaccines administered. Things remain elevated. The U.S. has slowed down a bit. The India has picked up a bit. UK is also pared back, but the world continues to trend up. You're seeing a little bit of a slowdown in Germany, but France, Portugal, all remaining elevated. China is getting another pick back up as you've had a spread of COVID in their country. People are like, all right, you know what, I've been lazy enough. It's time to go get it. So here's some of the shifts in general. And now when we break it down into its percentages, here's where you can also see some of those slowing. So when we look at just the U.S. for a minute, you can see the U.S. is at 49%. If you remember last week, we were at 48%. It's just because the share of people who are partly vaccinated continues to slow down. So that's where we're going to fall short of the 60% or 70% target that was quoted for June. When you think about just there's about 28% of the country that says, look, I don't want to get the vaccine. I don't think it's safe. I don't think it works, or I'll take my chances, or I already had COVID and it's going to do the same thing as me already having COVID and it's confirmed. So you're seeing some of that adjustment, which is why you're going to get to a point and then you're going to see kind of this stop where you're going to get to, with the, Canada's furthest along at about 70%. And you can see just based on where we sit right now, 65 to 70% is kind of where we'll see some of that top out. Now, when we look at jet fuel, just to round it out, you had a small build of just 80,000 barrels. It's still 4.1 million barrels above the 5-year average. And you can see here we made a new high. So when you look at just that demand, we kind of kissed that level right before say middle of June, came down. Now we're just falling below that low point of 2019, and then we're going to see this step back down. But we're not going to see this drop to 1.2. It's just going to be that 1.4, as we were saying at the beginning, that we were going to go from 1.6 down to 1.4 and just kind of stay within this 1.5 million barrel a day demand level. And here's one of the key sides. So when you look at just departures, you can see in the U.S., or I should say North America, things have really flatlined. Europe continues to trend a little bit higher, where here you can see rest of world starting to roll over, Asia Pacific flatlines. So then when you look, week over week, 370 departures were canceled, or I should say decreased week on week. So you're starting to see this flat line peaking in July 4th, and now starting to see some of this cool off. Globally, the passenger flight schedule for the 11 weeks ahead declined by around 1% since last week. APAC cut 2.5% across the next 4 weeks, a similar level to previous weeks. So again, we're not... and those cuts going forward 11 weeks, that takes you out of summer, that takes you into kind of that decline on a seasonal level. So we're going to see that come up and then come back down, which we're seeing play out as well in the passenger side. And this is, Again, what we were saying, that we were going to get a seasonal increase and then we were going to plateau. We're going to flatline at that level, getting up to 2.2, maybe 2.3, back down to 1.7, 1.8, and just live within this, let's call it a 2 million person average. But then we expect it to roll over with that normal slowdown as we go into the back half of August, because you have school starting back up. We're still slow on business travel. And remember, because some have now started saying that, well, we're going to get a huge surge of demand going into September and October. It's like, well, that's kind of hard when you have kids back in school and back in school full time. You're just going to see a seasonal decline, but you'll be closer to seasonal norms, but you're still going to see that dip. And then the question is going to be how many people actually go back to the office. You still have flex schedules, which has been very common so far. So again, that's going to be some of that overhang. And then to round it out, when we look at open table data, as we were saying, top 5% on the 5% better on the weekends, 5 to 10% worse on the weekdays, and that continues to play out. So now in the next segment, we're going to go into the international markets and look at the U.S. exports and kind of where that is sitting and what we expect going forward.